Hey everyone, Kaynes Technology has seen a sharp sell-off over the last 2 days. The trigger was Kotak's ESG report released on 3rd December, where they analyzed Kaynes' FY25 annual report and highlighted multiple reporting gaps. Overall, the stock is down more than 40% since October high. Now, when a stock is trading at a stressed valuation, even a small negative development can cause a disproportionate reaction. And that's exactly what has played out here. But the big question is, what were the gaps Kotak pointed out? How serious are they, and what should you do as an investor? Alright, let's try to decode this entire development on Kaynes Technology. So Kotak has identified 7-8 issues with Kaynes. First big issue is around Israkmako. It's a smart metering company that Kaynes acquired in September 24 for 43 crore rupees. Now Kaynes has reported that after acquiring Israkmako, it contributed 48.9 crore profits in just 6 months post-acquisition. And this profit formed 44% of total profit increase for Kaynes in FY25. Now just imagine you acquire a company for 43 crore rupees and it generated a profit of 49 crore within 6 months of acquisition. That is not easy to digest. But when Kotak checked Israkmako standalone financials, they found something interesting. Company's full year FY25 standalone profit is just 6 million rupee, that is 0.6 crore. It means either Israkmako has reported a loss of 483 million, that is 48.3 crore in first half of FY25, and from such heavy losses in H1 FY25, company has reported massive profit in second half of FY25. That is difficult to digest. Further, Kotak said that at 48.3 crore profit, Israkmako's net margin would be around 28% in second half of FY25, which looks high for smart metering business. So that's the first issue Kotak raised on Israkmako acquisition and reporting. Then second issue is the goodwill and reserve adjustments are confusing. To be really honest, this was a bit tricky for me to understand, but let me try to explain it in best of my knowledge. So Kaynes acquired Israkmako and Sensonic in FY25 for 88 crore rupees. And total goodwill calculated from purchase price was 114 crore. Normally when a company pays more than the fair value of net asset, the excess is recorded as goodwill on the balance sheet. However, Kaynes' consolidated balance sheet does not show a corresponding increase in goodwill. Instead, it reflects a net negative adjustment of 10 million rupee net of capital reserve alongside 561 million rise in general reserves. Management clarified that since a major part of the consideration is for a contract that Israkmako has entered into, it was recognized as an intangible asset and netted off against goodwill. But the catch is, there is no addition in intangible asset due to contract or customer relationship related assets. Second, no fair value adjustments are disclosed in the acquisition. Usually, acquisitions involve revaluing assets and liability to fair value. And third issue is, the payment for these acquisition is not shown as cash outflow. Basically, Kotak is saying that Kaynes' accounting treatment is ambiguous because goodwill is not showing as expected, intangible assets for contracts are not recognized, and cash outflow seems missing. Then third issue Kotak highlighted is disclosures for related party transactions are inconsistent. So related party transactions are done between parent company and its subsidiary. For example, if Israkmako buys part from Kaynes Electronics, that's a related party transaction. Kotak is saying that while Israkmako's related party disclosures show purchase of 1.8 billion rupee from Kaynes Electronics Manufacturing in FY25, but they are not reflected in Kaynes Electronics Manufacturing related party disclosures. Then fourth issue is Kaynes' operating cash flow post-interest stood negative at 0.9 billion rupee in FY25, primarily due to rise in working capital requirement. In fact, Kaynes has reported negative free cash flow in past 5 years due to high working capital and capex requirement. Further, with rising capex requirement for EMS, OSAT and PCB business, Kaynes' free cash flow post-interest and acquisition stood negative at 10.4 billion rupee, that is negative 1040 crore. In short, Kaynes is making money on paper, but cash is stuck in customers and subsidiaries. At the same time, company is spending heavily on new projects. Then fifth issue is Kaynes has big investment plan for its OSAT and PCB project. So OSAT is a business where a company assemble and test semiconductor chips for other companies. And PCB is printed circuit board. Company would need around 3,300 crore for OSAT and 4,680 crore for PCB setup. Now, over the past 5 years, company has raised most of its cash through equity and some debt, mainly to fund capex and working capital. As company still has significant funding need, roughly around 1,000 crore for OSAT and 2,500 crore for PCB. Currently, Kaynes has 1190 crore in cash, but its borrowing have risen by 880 crore at a high interest rate. The company expects government grants to cover a large part of these capex costs, but these are still pending. That adds to uncertainty. By the way, this is one risk we have discussed in our semiconductor video, where semiconductor setup requires thousands of crore and it won't be easy to fund it. So this is something that needs to be watched carefully. Then sixth issue is Kaynes is selling some of its receivable, that is money owned by customers, to bank to get cash faster, which is a process called receivable discounting. As of March 25, they have 1.2 billion rupee in such agreement, so around 120 crore. Selling receivable gives cash quickly, but it comes with risk of losses if customer don't pay, and rising bad debt provisioning could reduce the profit. Then seventh issue is in FY25, Kaynes cash flow statement shows 9.5 billion rupee spent on fixed asset. But when you look at actual addition to property, plant and equipment, work in progress and intangible asset, it only totals to 7.7 billion rupee after adjusting for advances and payables. In short, the cash spent on assets in cash flow statement does not match the actual asset additions because some spending related to acquisitions or lease lend, which should be classified differently. After this report, Kaynes has published a response on few specific points. Again, this is a bit too technical to comprehend. And its promoters also clarified on air that there are no fundamental lapses in disclosure but misunderstanding in reading of the document. But overall, Kotak report suggests that Kaynes numbers are getting harder to trust, cash flow pressure is rising and future funding needs are large. The business is growing, but the quality of growth, the quality of earning and clarity of accounting are the concern. This does not mean the company is bad, but it means investors need to be cautious. Watch disclosures closely and understand that risk around cash flow, accounting transparency and funding are elevated. By the way, recently Motilal Oswal has sold around 8 lakh shares from company. Motilal Midcap Fund has consistently increased stake in Kaynes every quarter and September holding was 5.84%. Now the big question is, what should you do as an investor? Should you sell it, hold it or buy it on dip? Let's have a look. See, Kaynes is undoubtedly a high growth company operating in sunrise sectors like electronics and semiconductor. But one thing that majority of people ignore is valuation. Since Kaynes has reported extraordinary growth in revenue and profit, market has always paid a super premium to it with its historical 3-year median PE of more than 100. This year beginning, its PE touched levels of 200. Kaynes was not just expensive, it was extremely expensive. But when a stock trades at expensive valuation, even a small negative development can trigger a big correction. Kotak report just did that. Nothing fundamentally collapsed overnight, but the confidence premium that has vanished. And this is a big investing lesson. When valuations stretch too much, the downside becomes brutal and quick. Great companies can still be bad investment if you enter at the wrong price. This context is important because the sell-off is not just happening only because of Kotak finding. The fall is bigger because the stock was richly priced, leaving no room for bad news. After the steep correction, Kaynes PE has corrected sharply. So what should investors do? So first of all, don't panic sell, but at the same time, don't ignore the red flag either. Nothing in the report says the business is broken, but the concerns are serious enough that you must track upcoming disclosures, quarterly cash flows and funding updates very closely. Second, you should shift focus from revenue and profit growth to cash flow quality. While revenue and profit growth is extraordinary, the problem with Kaynes is cash flow. And in any business, cash is the king. So you need to track closely the cash from operation. Third, I would suggest that be extra cautious about position sizing. See, if Kaynes form a large part of your portfolio, maybe it's time to rethink how much allocation you would be comfortable with. If your allocation is not too big, there's no need to react aggressively. Then fourth, I would say wait for clarity from management. Two things will matter most in the next 1 to 2 quarters. First is improved cash flow and working capital cycle and clear disclosure on OSAT and PCB funding and government grants. If these improve, confidence will return. And fifth, new investors should avoid chasing the dip. Let the dust settle. Let clarity improve. This is not a stage where you buy just because the price falls. But yes, this is worth tracking very closely as valuations have fallen a lot. Now you tell me in the comment, what are you doing with Kaynes shares? And do you think the issue highlighted by Kotak are serious? If you find this video useful, do share it within your circle. I'll see you next video. Till then, take care.